we should go ahead.
Yeah. Okay, great. So let's kick off the third webinar that we're having. Welcome everyone to this webinar. It is part of Celebrating Financial Inclusion Week. This is a global community effort which is put together by the Center for Financial Inclusion based at Axion in Washington, DC. So Move 78, Mariko Braswell, my partner there, and Financial Resilience Australia are so glad to welcome you to this third webinar. The topic that you're discussing today has come up in each of the other webinars as well. Remittances and migrant workers is such an important part of financial inclusion. But before we start the day, I'd like to acknowledge that I'm coming to you today from the lands of the Wurundjeri people of Kulin Nation. I'd like to pay my respects to the traditional owners of this wonderful land that we find ourselves in, and pay my respects to their elders, past, present, and emerging. So now I'll hand over to Mariko to kick this webinar off.
Thank you so much, Vinita, and welcome to all the panelists and attendees. Thank you so much for being with us today. We're thrilled to have you join us for our final webinar this week on remittances in Asia in COVID-19 and what can we do better. With the Pacific being one of the least banked regions in the world and 1/3 of the world's migrant worker population being based here in Asia, you add in a global pandemic and it leads to dire results. The ADB economists recently estimated that the region faces remittance losses from $31.4 billion to $54.3 billion, and that's in USD. So today we'll hear from our panelists from their varied perspectives about what the major hurdles and pain points are for the remittances and the remittance process right now. I'd like to introduce our moderator and my colleague, Jerry Ferguson, who's a senior advisor to us. And Jerry has been in financial services for the past 15 plus years and has been working with some of the world's largest financial services companies across APAC. He's been applying his knowledge to the tech and banking industry and lately to the fintech and digital banking industries. So we thank him and I'll leave it to you.
Thank you very much.
Jerry.
Thanks, Mariko. Thank you very much to you as well, Vinita, and thanks to all our panelists and audience for joining us this afternoon. It's a Friday afternoon where I am. It may be a Friday morning where you're listening to this, so we're going to keep this light and fun and have a really strong conversation around remittances in Asia within the context of the COVID-19 pandemic. I'll get to my illustrious panel in a minute, which consists of an entrepreneur, an economist, and an academic, which sounds like the start of a really bad joke, but hopefully it won't be. So we'll try and move through without getting a little too silly. I think one of the interesting things that we look at and why we wanted to talk about this topic in particular, as Mariko highlighted in her opening, there's some really staggering numbers that are coming out of the region as a result of the COVID-19 pandemic. And for me, one of the interesting areas to look at and unpick, which we will do today, is to figure out, what was an issue before COVID-19, what's an issue because of COVID-19, and more importantly, what will the issues be going forward off the back of this. And hopefully, when COVID-19 dissipates or moves away, then we can start to think about those. To set the scene, I want to talk to Badri Narayan first. I'm reading a report recently you did, Badri, for the Asian Development Bank. Staggering statistic for me that the COVID-19 pandemic threatens the job security of over 91 million international migrants from the Asia and the Pacific region. That is a huge number. Can you give us a little bit of the highlights of the report, what you're seeing and what the impact of this pandemic is sort of bearing fruit?
Yeah, thank you, Jerry. Beyond the numbers, what we broadly looked at in this report and what we found was that we first modeled the overall economic losses coming from COVID, and that's mainly because of the economy is shrinking overall. So when the economies are shrinking, when the consumption, trade, investment, all these different elements of GDP are shrinking, that's going to affect people at large. and there is an impact on employment and wage income that is very clear. And a large number of people lose jobs, and some people may retain their jobs but face a heavy cuts in income, wage income. So this is the situation that you see overall because of COVID in the economy, and how people at large are affected. Now, taking this specific case of migration, what we did was we took this overall slump in the economy, global economy, and how this is panning out in two different scenarios. We looked at a baseline. In fact, I must say that when we started the study, we had a baseline and a pessimistic scenario. By the time we finished the study, the pessimistic scenario became the baseline scenario. So, and then we had to do another pessimistic scenario. So it's kind of quite crazy the way things evolve so dynamically. So in the baseline scenario, which was basically the pessimistic scenario of a previous report we published with ADB, that was in May, that was on the global economic impact of pandemic in general. So that negative scenario there, what we said was, because of this economic impact, which happens in different countries in the world, some migrants, some people are migrants who belong to countries that are affected a lot, and some of them could be migrants who are in the destination countries that are affected a lot, and in both cases they suffer. So when the job losses happen in the destination countries, in the countries where they live, they're in a really difficult situation. One, because they lose their jobs. Two, those who don't lose their jobs, they get their wages reduced. And number three, they don't have mobility, and they typically live in a higher cost of living kind of country, because they typically come from poorer countries. For example, they may come from Bangladesh, or Nepal, or India, Pakistan, and so on, and they may be living in UAE or Saudi Arabia and so on, which are way richer and higher income countries. So now they are stuck there. They don't have a job, they don't have their income, and then they are stuck there without being able to go back. So these are the 91 million number that you mentioned. That's a number of people who are at risk. And then we found some numbers in the report. You can see as to how those the employees are affected, the migrants are affected. Secondly, because of the reduction in remittances that they have been repatriating to their home countries, the home countries are being affected. And this is probably one of the rare instances in the recent past where a lot of people who have actually come out of poverty line, who have been long away from poverty line, and they've been doing pretty well, like kind of middle class-ish kind of people, they have been brought back to below poverty line. And that's a tremendous issue this time. And migrants have been forming a major part of that, because they left their countries because the income wasn't sufficient, and they were making decent living in or decent income in other countries, and now they lose that. So basically, what we also found in our study is that the hard work that has been done over time to reduce poverty, we kind of try to plot it over time. How much poverty have we reduced within these few months? We might have gone 3-4 years backwards, and if you look at the actual extent of poverty reduction, that is quite amazing. In the last few years, we have actually globally have done a pretty good job, globally and particularly in Asia Pacific. We've done a great job in reducing poverty, and a lot of it is being undone now in this very short time. I think before I conclude, for now I'll come back again later. But one another major kind of point that we emphasize in our report is that assuming that this is kind of a temporary scenario, how temporary is for everyone to guess. It's not clear. Some of the elements could be permanent or semi-permanent. They can, like restaurants, hotels, and so on. They may stay closed for a longer time. Now, assuming that a lot of these migrants and employees are going to be stranded for a while, we expect a lot of effort by both the source countries and the destination countries, the countries from where they come from and the countries where they stay. They have to make a lot of efforts, one, for some income security, give them at least enough to sustain. Second, to repatriate them, bring them back to their homes. And third, to get them some kind of jobs, basically. So create jobs. And this is possible through a wide range of policy measures, obviously income support, some kind of subsidies to the consumption subsidies and so on. And also fiscal stimulus, where countries can start doing some infrastructure projects and so on, where they can create some employment and boost the economy in that way. It can both boost the macro economy and provide jobs for people who are coming back and so on. So I think sorry for the long,
No, that was great, Badri.
But I'll come back again after I have more questions.
It's always nice when you're doing some global modeling and a pesky pandemic comes along in the middle of it and completely changes your baseline assumptions. I'm sure that was slightly annoying for you. Ross, I want to bring you in here. Ross is the professor of disruptive innovation. I'll ask you a little bit about your background, but you've been looking at the issue of cross-border payments for a long time now. How much of this is a new issue in terms of the struggle around remittances? We know, I think we'd all agree on this program that it's an inefficient system at best, but how much of these issues have been around for a while? How much is being shone a light on now because of COVID? What's your sort of take on where the play was 12 months leading up to this and even longer before?
Yeah, thanks, Jerry. Well, even going back 7 or 8 years, this was a big problem, right? This has been a big problem for a long time. It was getting worse in the last few years because basically remittances are a very important source of income. But I'm coming to you from Sydney. Our corner of the world, the Pacific, have some of the most remittance-dependent countries in the world, Samoa and Tonga in particular. You're looking at upwards of 25% of GDP represented by remittances, so incredibly important. The banks are the last channel standing for remittances, but the banks are very, very expensive. So the money transfer operators are the small businesses that can do this business much more cheaply. But the banks have been putting the money transfer operators out of business in a process that the banks call de-risking. And the justification they give is that AML CTF rules, anti-money laundering, countering the financing of terrorism rules, they claim that their US banks, their US correspondent banks, want the Australian bank to have visibility on where the money's going, not only the money transfer operator, who is their client, the customer in Australia, but where the money's going in the recipient nation. And they claim that without visibility, full visibility on all of that, the US banks will not provide correspondent banking services for them across the board, which means basically they're out of business. I say claim because there's no way to verify that. But what it means is if an Australian bank, and I'll speak more about Australia, I know people are on this call from all around the world, but I understand the market here better. And I think the issues are exactly the same. Highly rich developed country banks around the world have been putting money transfer operators out of business for at least the last 5 years. It's a problem in the UK, it's a problem in a lot of markets. And it's an ugly term, de-risking, because it's de-risking from the point of view of the banks. It's certainly not de-risking from the point of view of the migrant workers. It's not de-risking from the point of view of the recipient economies. It's an increase in risk for them. Because what it means is the people who can move money relatively cheaply are forced out of the market and you're left with the banks. And their fees are very high. Between Australia and the Pacific, are some of the highest remittance corridors in the world. You can have 10 and at times up to 20%. So, if a worker from at some points in the past few years, people from Vanuatu have had to spend up to $100 to move $500 money back to their village in Vanuatu. And if you think about it like that, it's really like banks arrogating the taxing power from the sovereign and taxing these workers directly. It's just exactly like a tax on the transfers. And there's absolutely no justification for it. And sometimes it's the same bank in Australia and in the Pacific. It's merely a book entry, but they insist on doing it through their old legacy software systems. They insist on doing it old ways. And because, of course they do, because they like charging 10% in transfer fees. So it's really a tax on development, which is why I've been interested in it for so long, because it's so inequitable.
A really interesting point there around the sort of legacy problems that banks face and where they route these remittances through. And I suspect, Miko, this is a great time to bring you in. Miko is the founder and CEO of Ayana, which is, he doesn't like me saying this, but it's a fintech startup. But he'll explain more about what it is himself, and he'll do a much better job than I can. Miko is also, quote unquote, a reformed banker. So he straddled both sides of the fence. So he has a social conscience, but he's spent some time in the investment banking world. So he's a rare breed. Miko, question to you in terms of that concept around, the traditional way of doing things is slow, it's expensive, it's cumbersome. How have you sort of approached that, and what are you seeing from an innovation standpoint around making this a better process for all?
Well, thank you, Jerry. Thank you for the introduction, and very nice to be. I'm happy to be here on this panel. So I think Badri gave a very nice sort of macro view of the situation. It was bad then, as Ross put it, and it's worse now. And Ross actually also somehow encapsulated the problem that a lot of migrant workers face in supporting their families in their home country. I agree with Ross. It's been actually quite, how would you say, egregious system from the perspective of the migrant worker and the recipient. Although I must say there's been some progress technology-wise from where I sit. Obviously, Philippines is, just to put some context, is if I'm not mistaken, the third largest recipient of inbound remittance in the world. Every year, last year, we received 34 billion US dollars, and that's been growing at like a 3 or 4% CAGR over the past several years, as more and more of our Filipinos move overseas to work, not just as immigrants but also as guest workers. We've been in the business for 10 years. Ever since I got out of banking, I decided to get into this fintech, but and we've seen sort of the issues in remittance. In fact, that was the first sort of transaction flow that we decided to focus our lens on, is as technology people and financial people. How do you solve this problem? Because back then, I think 10 years ago, on average, it was like 12% of the principal amount is what our sender would spend to send money home. I just realized now, and after seeing the ADB paper of Badri, that it's even worse in some of these smaller corridors, like between Australia, New Zealand, and Tonga, and Kiribati, and Vanuatu. That's even worse, like 20%. That's really amazing that those things are still existing. So what's happening is, globally, I think there are three trends. The big right now, the dominant sort of mode of transfers is still through the banking system. I would say that the vast majority still go through the banking system, in spite of it being inefficient, and in spite of all the forces, the competitive and forces that are making it harder for money transfer companies to do this. But there's been two innovations that have actually, over the past 5-7 years, to have that kind of reduce the friction. Is number one is, of course, the advent of smartphones, and having more people in the developed world, were in the sort of the originating countries, having access to mobile data, and including migrant workers. In fact, probably the first thing the migrant worker will get in Singapore or in Hong Kong or Dubai would be a mobile phone, because they need it to connect with their families in their home country. And so that, plus the banks, of course, have started using mobile banking. So that kind of obviates the need to actually walk to a counter, which is, I don't know if you've ever been to Hong Kong or to Singapore on a Sunday, but you'll see a lot of our migrant Filipinos or migrant Indonesians sort of congregating around the World Finance Center in central Hong Kong, or the Lucky Plaza along Orchard Road in Singapore on their day off, so that they can actually rip money through the money transfer services. So now with mobile banking, at least those who are banked among the migrant workers have they've been relieved of that inconvenience of actually having to physically walk to the money transfer counter to do the transaction. Obviously, they're still at the mercy of the fees of the banks, right? So the other next step is sort of so there are these companies like in the US, there's called Remitly, and also Zoom, which has actually been around for almost 20 years. It's actually a listed company on the Nasdaq already, just been acquired by PayPal, as well as, let's say, in Europe there's TransferWise, or in the UK there's Azimo. So these are sort of non-bank money transfer operators that are making it easier again using mobile devices. So actually, apart from the banks actually are in partners with the legacy money transfer operators. The two big ones are MoneyGram and Western Union. And Western Union is still a dominant player. MoneyGram, these are what you call the agent-based remittance players, both on the origination side and on the recipient side. So they're like the, how would you say, the last mile, but the transactions are still cleared through the clearing systems of the bank through the Swift system. So and obviously, I think when you mention 20% of principal, it's normally because of these legacy rails, if you will, the dominant ones being MoneyGram and Western Union. So the online players have actually slowly sort of like eroded that dominance of these legacy sort of over-the-counter agent-based remittance players on the particularly on the send side. On the recipient side, what I've noticed is that the the over-the-counter players are still persisting, partly because, again, in emerging markets like the Philippines or India or Bangladesh or Pakistan, again, the not everyone is banked, number one. Number two, not everyone has access to mobile data that is cheap and reliable. So people still have the cultural habit of picking up their cash remit transfers from a counter, from an agent. The latest data I got was at least 90% of global remittance. It's like close to $700 billion is still picked up over the counter in the developing countries. So that's the part that still needs to be optimized. Our company is actually for money to flow between this sort of like agent-based networks. So uh, we realized there was a problem when it comes to cash liquidity or availability in these last mile agent networks. So that's what we're solving by creating basically an interoperable system across this network. So we're creating sort of like in the United States, there's this thing called the automatic clearinghouse. So in effect, we're doing that, but instead of working with the banks, we're working with this remittance operators. The other thing that's actually helping solve that as well is the rise of crypto. Although it's debatable how much of a dent they've made in terms of cutting down the remittance costs, but there's the emergence of these crypto rails that are basically trying to work around the Swift system. So I'm not sure if you've heard of a company called Ripple. They actually own 20% of MoneyGram now. So basically, they're building alternative rails that are not connected, decentralized rails not connected to the Swift system. So these competitive pressures, technology at the same time, sort of competition, is actually moving the cost of remittance down globally. From my understanding, from 12% of principal, it's now down to around 7% of principal. Again, that's on average. I'm sure there are corridors that are still very much very high, even in the Philippines. So technology, as Ross says, I think it's inevitable. Eventually, technology and competitive pressure will bring down. In a way, it's like a race to zero. it will probably settle down somewhere at the merchant discount rate of, let's say, 2 or 3%, basically the cost of holding cash, right? Because eventually there's still going to be some kind of settlement that goes on, whether centralized through Swift or decentralized through the distributed ledger systems and the cryptocurrencies. So I think we can look forward to lower remittance rates, making it more convenient and making it more cost effective for both the sender and the recipient. That's sort of the view. Of course, that's a long-term view. Meantime, we have a crisis going on. The pandemic basically exacerbated the problem, and there's a lot more that needs to be done apart from technology to solve these problems that migrant workers face. Because if you lose your job, no amount of technology can help you send money back to your home country.
Right. Yeah, Mika, thank you. There's some really great themes in there that I'd like to kind of drill down on with the panel. The first is we talked a little bit about the impacts of COVID, the impacts of going to a teller and the remittance in cash. Badri, have you seen anything in your papers recently around how much cash is actually being used now? Has that decreased? And maybe Mika, you've seen it on the front end. Have we seen a significant decrease in the usage of cash in this system because of COVID?
I think this is a trend that is happening over time. I'm not sure how much we can attribute to COVID in particular. And I think, as Miko said, and also Ross mentioned, I think because of the changes that have been happening very quickly now, which are like a lot of examples that Miko gave are, technologies that have been existing for a while, but their use has been accelerated a lot in a short time. And I think that is bound to have an impact on usage of cash. At the moment, I haven't looked at the data in detail, but if you take India, for example, I've seen that over, a couple of years ago, there was this experiment of demonetization of declaring notes to be defunct. And that had a pretty large impact on move towards cash. And a lot of street vendors and even many of the informal sector businesses and workers, they moved to transactions through technology. And actually, one interesting thing that I've seen in India, not in many other countries, even in US, is that you can do transactions just by SMS messaging, texting, and you don't even need the mobile network. You don't even data, because almost mobile penetration has been pretty big there. But the data penetration right now is great, but 1 or 2 years ago it wasn't that big. So I think these kind of technologies, as they evolve more and more, that can actually promote moving away from cash and going more in terms of digital payments. And I think crypto has a big role to play, although it's right now catering to a relatively small population because not many people are aware of it. So yeah, I think that's my overall observation on this. But I haven't seen the actual data on cash usage in the recent past. I think it's a nice research question to analyze and think about.
Yeah, it's if I may add to Badri, I think definitely cash usage has decreased, at least from what we're seeing. It's just that okay. So over the years, it was really adoption of digital at least in the Philippines and in other emerging markets was maybe going like this, and then come first quarter 2020, we're like this. And we see it in the way, because we still run top-up centers for the wallets here in the Philippines. So the usage has increased, definitely because of COVID. Now, however, we're basically just 2 quarters or 3 quarters into the pandemic. It's interesting now in my WhatsApp chat messages, I see the people are reporting, the banks, the wallets are reporting increased usage of digital. But the data's not quite there yet. I think it's a little early, but maybe after another quarter, so we can establish really the trend lines. But definitely, even in emerging markets, digital solutions, contactless solutions are are obviously becoming more imperative. What I do see is sort of the rise of what I call hybrid systems. Banks are connecting with cash networks so that so that the people who used to actually who for example in the Philippines, the banks have been approaching us to connect to our sort of our remittance network. That seems to be a trend. So it's sort of like a still sort of a they call it a phygital or offline to online sort of model,
Yeah.
where you still need this cash rails, these points of presence. But at the same time, yes, definitely, unquestionably, there's been adoption of digital, not just in developed world, but more so in emerging markets. The acceleration is happening very fast in the Philippines.
Yeah.
Interestingly enough, we launched a product last year before the pandemic, which is basically a mobile POS system, a mobile ATM machine. It's an Android device that's connected to the ATM switch, the national ATM switch. So someone with an ATM card can go to, let's say, a fishmonger or like anyone with a retail store that has cash in their till, and instead of drawing it from an ATM box, basically it's the store owner can dispense the cash from their cash register. And the adoption rate of that has been growing fast. I think because I think a lot more people are getting their funds through an ATM account. Interesting enough, across Asia, ATM penetration is still quite low. If you look at India, I think it's like 18 per 100,000 adults. Philippines is around like 28 per 1,000 adults. So even though there's sort of like this how do you say, I'm not sure who's going to win out, whether electronic wallet will take over and no one will need an ATM machine, right? Because everyone has basically an ability to pay and to accept electronic payments, or there's going to be basically what's going to happen is you're going to have coexisting sort of modes of payment and transactions, either through the banking system or cash to bank, bank to cash through ATM machines, or purely EMI or wallet type of systems.
Mhm.
I think what's going to happen is these are going to coexist. In the case of India, because I'm very actively involved in sort of like understanding the fintech ecosystem in India, having friends at Paytm and Google Tez. Yes, demonetization a few years ago gave the wallets a boost, but from what I gather, down, people still go back to cash. So one of my friends who's based in Bangalore told me in China, because basically it's an authoritarian system, basically the Communist Party says everyone has to use Alipay, everyone has to use WeChat Pay, and you can't not comply, right? Or else they take you at the back of the courthouse and shoot you in the back of the head or something like that. But in a democracy, obviously you have to have people have choice. So I think in India it's probably going to be more like that. Although across Asia Pacific, a lot of the banks are actually trying to now do real-time settlements, something that probably if you live in Australia, they take for granted because you have this EFT or whatever. But in the Philippines
Doesn't
and
exist.
India, more so actually, the Philippines is a little bit behind, but India, Indonesia, they're already done a lot of with the UPI and the Aadhaar and real-time gross payments and even retail real-time. So eventually technology is taking the friction out of these transactions, particularly remote,
Yeah.
cross-border transactions. Yeah.
Ross, in terms of that adoption curve and the innovation reducing the friction of these pain points, how far off are we from a truly digital world?
Well, that's always the challenge, Jerry. I mean, I agree entirely with Miko. The technology will solve the problem. But I think generally when it comes to technology, it's relatively easy to predict where we're going. It's very difficult to predict the timeline. I remember I listened to Bill Gates at the World Economic Forum in Melbourne in perhaps 2001 or something. And he was absolutely certain within 3 years, you'd be able to travel anywhere in the world with your mobile phone. You know, I could speak into my mobile phone in Manila and it would translate it in real time to somebody and they could listen to it in the local language. And of course, so he was absolutely emphatic we would be there by 2004, and of course we're still not there, you know, but it's still right as a destination. We will get there at some point. I mean, the technology longer term will solve this for two reasons. We're moving to a world where central banks will issue digital currencies. China is already doing that. They call it DCEP, Digital Currency Electronic Payment. They're trialing it right now in 4 major cities. And so they will have a digital currency, which will just be a normal renminbi issued by the central bank, but existing digitally. Now, this is a huge change because it's putting central bank money in the hands of ordinary people. And at the moment, the only central bank money you have on a daily basis is cash. Everything else you deal with, the way you pay your mortgage, the way your salary gets paid, all of that is done by commercial bank electronic money, you know, commercial bank debits and credits. So this is a fundamental change. A number of central banks around the world have been working towards it for a number of years, but nobody's been willing to do it. Eventually, China has pulled the trigger. They haven't been willing to do it because it's such a big step into the unknown, but China's pulling the trigger for a number of reasons, but one of them is COVID, right? One of the things that pushed China across the line is COVID. The other thing that pushed China across the line is Libra, which is Facebook's proposed global stablecoin, which is a private stablecoin. So obviously, a stablecoin is just a cryptocurrency that's tied to something that makes its value stable. So earlier, the other panelists mentioned that cryptocurrencies, it's hard to know how much they're helping. Well, the big cost with cryptos is they bounce around like this, right? The value is very unstable. Whereas if you have the modern version of Libra 2.0, you'll be able to get a Libra coin, a token, in an established nation's currency. So it won't move any more than the Australian dollar or the US dollar. So on the one hand, you'll have central bank sovereign digital currencies. On the other hand, you'll have private sector currencies, stable coins, and either of those will largely, once they become available for international use, will largely solve the problem. But whether we will get there in China domestically, I suspect, in a couple of years. We'll be there in Sweden in a couple of years domestically because cash is disappearing out the back door. Already 2/3 of bank branches in Sweden don't carry cash of any kind. So we'll get it in selected countries, but the question is when it will be allowed to be used internationally. But it will, because these digital currencies will interact with trade documentation far better than our current payment systems. There's huge savings to be made. So eventually, I think the whole remittances problem will be solved by either a government or a private sector stablecoin. But be a nice person and don't ask me why. When? Because I'm not sure on the when.
I won't ask you when, but I might ask you, we talked a little bit about the adoption curve, and do you see an issue generally, and certainly in research that I've seen, you know, trust plays a huge part in a lot of the adoption of what we're talking about here.
Yep.
How do we get around that? I mean, if we're talking about what was a predominantly cash-driven remittance corridor, we've asked them to move to mobile adoption, which for a lot of countries is now ubiquitous. We now ask them to skip that effectively and go to a cryptocurrency, which they know even less about. Surely that will have an impact on the uptake.
Yeah, absolutely, and that will be one of the things that will really slow it down. But the flip side of that is why COVID is driving digitization in so many sectors, because a crisis is a good thing to get people over their cultural resistance to doing things a different way, right? And, you know, I notice, you know, 6 months ago, I was really not very skillful at all on all these different platforms, you know, Zoom, WebEx, and all the rest that my life now happens over. I've got a whole lot better in 6 months. Still not very good, but I'm better than I was. And it'll be the same with using these sorts of things, you know, when people are forced to, and the costs in some of the corridors are so high. Once viable alternatives spring up. Part of the problem in my part of the world, Miko was talking about these technological alternatives. the banks actively shut the accounts for any entity that's trying to use that. They're really aggressive, incredibly aggressive. If they see any behavior they think looks like international money transfer, they just close the account with no, you just get a letter saying your account's closed.
I know that from painful personal experience.
Yeah, it's really quite, it's extraordinary behavior, which displays a complete and utter absence of any sort of social conscience. They do not see that they have any obligation to try to assist people in poor countries whatsoever. It just doesn't register in on their radar. It's extraordinary to me.
If I may, maybe I can add a little bit of sort of color into that comment.
As long as you don't defend the bankers, Miko.
No, not at all. No, I'm a victim. Basically, I had like we had like HSBC accounts shut down arbitrarily, and you know, it had like hundreds of thousands of dollars sitting in those accounts, and it was incredibly it was so difficult just to get it out of HSBC and get it back to another account. I think part of the reason why that is the problem is because of the U.S. federal government. A lot of these banks clear, since the U.S. dollar is still the clearing currency so far. As far as we so far is that a lot of these banks clear all these cross-border transactions through U.S. banks, and because of you know, the U.S., whether it's for good or for bad, no matter what, the career of the New York district attorney actually is made if they can bust someone for money laundering or something like that. So these banks have taken a big hit. HSBC, Standard Chartered, they've been paying billions of fines. So they said this is not worth it. So they just cut out anything that's cross-border. So yeah, it is a problem. I think you're right. These stable coins might be part of the problem. I think part of the solution. And there are a lot of experiments going on, Cello, Tether, etc. So XRP, yeah.
Yep. And I think part of the issue, frankly, is a cultural issue. Americans don't send money home to the village, and they think the idea of immigrants or sending money home to support their families in a village is culturally foreign. It doesn't stack up to them. So they think there's something suspicious about any money moving across boundaries because it's not part of their culture.
Well, I guess that's partly, but also, you know, you have to understand, like the biggest bilateral corridor for the U.S. actually is Mexico, and as you know, that's also sort of the same corridor that drugs and human trafficking are going through. So there are reasons why they're very strict when it comes to anti-money laundering or and of course with 9/11, obviously the Patriot Act, they're very, in a way, these money rails are the ones that are funding some of these terrorist organizations. So yeah, so
I warned you, don't become all balanced and reasonable on me, Miko. Now you're becoming all balanced and reasonable.
Well, yeah. So, but yeah, you're right. Mexico is the big. I think as a corridor bilaterally, that's the biggest source, and I know that's the problem because of the drug trade. Also for the Middle East, because of 9/11 and terrorism, they've really gotten strict. So I think what's going to happen is more and more people will retreat from the U.S. banking system and move elsewhere. So even us, for example, we would like to open clearing banks with banks that do not clear through New York or to the U.S. because it's just too much pain and trying to deal with them. Yeah.
And that's why I think
exactly.
that's why China will let its digital currency offshore, because it wants to take that business away from America. That's the strategic imperative.
Yeah.
So Miko and Ross, I mean, these are. Sorry, Badri, you had something to add there? Or?
Yeah, just a small aspect here. I think when it comes to trust, I think there are two elements of that. One is the perceptive trust, where people accept these new things and they think this is going to work and so on. That's kind of a psychological thing. Another thing is kind of an objective trust, which is all these movements of cryptocurrency, blockchain. This whole movement is about commoditization of trust. Right? Trust is something it's not a central thing. Trust is not like the central bank has to say that this is a currency and so on, whereas it's decentralized. And so the whole the trust has these two opposing effects on adoption of these technologies. So one is it's actually people who really understand it, they know that it's actually enhancing trust, and others may think that it may not. So that's one thing. And the second thing is all these discussions that we had now, they also point out to another element, which is the security of transactions, the cyber security and the security threats that are involved. Although we've discussed the flip side of being proactive on or hyperactive on that. That's what Miko and Ross are talking about. Also, I personally have felt the other side of it, where I do all my transactions online, and then I realized somebody had hacked the account, and then it happened a couple of times, and we had to close the account and so on. So, like at that point, I was also thinking that what Miko mentioned, that there could be a coexistence when these things happen. The trust element that I mentioned earlier, that may lead people to think that maybe we should stay away from all these things. There are people even now who say no, we should not have a smartphone, like we should be away from technology. And in that sense, I think the coexistence probably will be facilitated by that part of the population, which would say that, okay, whatever happens, I'm not going to have an online account. I want to go to the bank and get the cash. So I think that is part of the reason why coexistence may be there.
May I add to Badri's comment? What's interesting is there's been studies made that even in developed countries like the UK or the United States, when economies go into recession, like what's happening now, people tend to become more cash based, because when you don't have enough money to keep in a bank account, there's no point just keeping it in a bank account. So my understanding, like in the UK, when there's economic slowdown, there's a recession, people tend to be more cash based. They don't want to keep stuff lying around in a wallet, right? An extreme case in the Philippines is that, because it's actually not so much also what mode of payment or transaction you use. Sometimes it's just not having enough money. So for emerging markets where there's still a lot of people below the poverty line, that's a big issue. Several years ago, we tried to launch a public transit card, like a Clipper card or Octopus card or Oyster card in the Philippines. And then we did some for the trains in Manila, and we did some surveys of people, and they say, you know what, even if it's more convenient because I don't have to line up and get a ticket, I can just tap it on the gantry and walk in the turnstile. But for some blue collar workers, they just have enough money because they're paid daily, that they only have they only have cash for the journey to their workplace, and they have to wait until they get money from their employer so that they can go home. So it's not even a question of convenience; it's a question of just not having liquidity. So so there are a lot of moving parts here, and that's why I believe that it's still going to be coexisting. That maybe in some very wealthy countries like Sweden, or small countries like Singapore, where it's easy to implement this, or an authoritarian state like China, you can move entire populations into a digital realm. But at least from where I sit in the Philippines, and from what I hear from my friends in other emerging markets like India or Indonesia, I think cash will still be a part of the mix in one way or another. Maybe not as dominant as before, but it will coexist with the digital modes of transacting.
Yeah, I think you're right. I mean, there's a couple of great sort of touch points on that. Badri, to your point around trust, we always, one of my favorite sayings is that trust arrives on the back of a tortoise and leaves in a speeding Ferrari. It's not something you can market. It's not something that you can build around. It's something that you need to actually show. You can only build trust by doing what you say you're going to do and doing it well. And that's something that banks consistently struggle with. When they introduce any sort of new technology, they need to show the value of it. They need to show that it is safe. But it's a double-edged sword because to your other point, you don't want to talk about security too much because then it raises people's eyes around, well, why are you telling me it's so safe? Because, is it not safe? Are you overselling this to me? People are generally pretty accepting of things. In terms of that, the cash and the hybrid and where those things are going, I think we will see, you're right, there will be a transitional period. It's not a binary shift. We're not seeing a binary shift, for instance, from branch-based banking to internet-based banking. Obviously with COVID, yes, there's a restriction around what you can do in a branch. But I don't think when we see things open up again, people will immediately stop just using digital. Those that like to use face-to-face banking relationships, remittance relationships, will continue to do so. And as you say, Miko, there's a number of reasons for that. I think the challenge around this, as you say, is there's many moving parts. There's a policy aspect to this. So what are the governments doing to help promote particular channels? And Ross, you touched on that at the very beginning. There's a technology aspect to all of this in terms of how good is the technology? Does it actually service the need that's there at the moment? And Miko, I know you have a vested interest in that, and your technology is very good. But how quickly can we get that across into the source countries and the destination countries? Because it's one thing having it at one end of the pipe, but if it doesn't get to the other end, then that's not much of an issue as well. The education piece around all of this is obviously a huge part of it. I heard a great phrase in one of our webinars yesterday, which was around edu-action. So it's not about education, but actually, talking to them about the how rather than the what. So how they actually do these things rather than what they need to do. And that's going to play a huge part in the adoption of all of this. So there's lots of moving parts. There's lots of different elements that we can talk about. Maybe just as a final thought from each of you, where do you see the remittance world going in the next 6 months, and then let's look a bit further and imagine a world in 5 years' time? Miko, I might pick on you and start with you.
Sure. No, I certainly think digital. I mean, the shift to digital is unquestionable. Although, of course, there are going to be constraints to sort of adoption, but definitely we see it that more and more of these migrant workers in the source countries will adopt these offline channels in order for convenience and for cost reasons. And it's up to basically the regulators and of course the service providers to make sure that the services are reliable and cost effective. So it's interesting. I've spent some time chatting with migrant workers in Dubai, in the Middle East. It's actually the Middle East is a great place to learn about these things because there's a joke that if you throw a rock in a shopping mall in Dubai, you're going to hit an Indian guy, Pakistani guy, or a Filipino guy. Most likely it's going to be a Filipino guy. There are more migrant guest workers in Dubai than there are locals, actually. So it's a great place to learn about this particular type of personal cash remittance. And they're actually, the migrants are very savvy. They're very savvy. They would make great forex traders because they're so particular about the spread that they will calculate down to the fourth decimal place the conversion rate because they want to get the best deal for their hard-earned money because they work their butt off cleaning toilets and they need to send this back home. So they want to get the best deal. So they're if I were the banks, if I was running a remittance company in of course, if it's a monopoly, there are barriers to entry. Obviously, the banks have a great way to rent seeking, as Ross puts it. But if there's a way to remove those that ability to get rent, the senders themselves are the best source of feedback on how to make the service more how do you say, effective, removing the friction from the system. So, but it's going to happen. It's going to take a while. I'm excited about the crypto and stable coins and digital currencies. I think I agree with Ross. Eventually, all central banks around the world will build their own digital currencies eventually. And that's basically to stave off the and maybe by then the value of Bitcoin will go down further. We'll see. But I think that's where it will be in the next maybe by it's interesting, like a country like Japan, a big chunk, more than 50% of transactions are still in cash. You'll be surprised.
Yeah.
For the second largest economy, well, maybe third largest economy in the world now, it's still interestingly how cash has persisted. So I think the jury's out. So I'd rather straddle, as Ross puts it, and have one leg on the cash system and another leg on the electronic system. Yeah.
Beautiful. Ross, final thoughts from you?
Yeah, I agree with Miko. Technology is going to solve the problem. The question is how many years before we get there. What we need in the interim, I think, is a whole lot of pressure on governments to put pressure on banks to support money transfer operators, to support the interim solution. And the challenge with that in a country like ours, Jerry, is that Samoans and Tongans and people from Vanuatu don't vote in Australia. It's terribly difficult to get Australian government people to take these issues seriously. But I'd also echo what Miko says. There was a time I did a lot of work on mobile money in developing countries. And in a lot of these countries, these people are so savvy, they travel with 3 SIM cards in their pocket. They'll swap from one provider to another provider at 4 p.m. because the other provider's rates go marginally cheaper. And yet these are the people that the rich country banks are effectively taxing on their hard work when they try to send money home. It's extremely unattractive stuff, and our governments have a moral responsibility to respond, but whether they will, difficult question.
Perhaps for another webinar at another time. Badri, your final thoughts, and it sounds like you're probably going to have to go back and do some more modelling based off all of this, so I'm sorry about that, but I know that's what you like doing anyway.
Yeah, no, I think, it's always interesting to explore what is happening. I think I completely agree with Miko and Ross on the first observation that we are going to gravitate towards more digital currency, digital payments, and so on, and less cash. How much, what will be the proportion, when it will happen? It's again, it's open. And I think, but there are a couple of other things I want to mention. One is the changes that are happening now. Some of them could be long lasting. For example, a lot of migrants may return to their home countries, so the need for remittances itself might come down a bit over time, or it may even bounce back if we have a good solution, and if things change. I don't see things changing in a year or so, but at some point, if things change, maybe people will travel more and migrate more and so on. This rebound effect, when things are really bad and then they get better, then the demand will double what it was before. And those kind of things can happen. But at the moment, I see that is another factor in terms of how much, like what Ross and Miko mentioned, and how much pressure is going to be on the government, on the banks to fix these things. Also depends on how much demand is going to be there in this mix of things happening. People going back, and I think another trend I see in countries like India and Vietnam, Taiwan, and so on, is that we have this larger global value chain recalibration that is happening, and a lot of industries are moving from China to some of these countries, and that is creating more employment opportunities, more industries, and so on. And that also might absorb some of these migrants who are coming back. I think these are some other elements, some other macro economic elements that might play into the motivations and incentives of the policymakers and the bankers to adopt some of these technologies. So I think that's one position.
Yeah. Okay. Well, listen, I think we're bang on time. Thank you all very, very much for your contributions. I think what we can all agree on is that who knows what's going to happen in the next 6 months. So we'll probably just have to do another one of these in 6 months' time and revisit where we all are. But my takeaways from this are: look out for the Perez-Buckley global cryptocurrency, and we'll all be trading in that in the next 6 to 12 months. So that's fantastic. Listen, thanks very much for your time, guys. To the audience and the questions that were sent through, thank you very much for all of that. I hope that was helpful. I hope that was informative. And with that, I think we'll end it. Mariko, Vanita, if you want to come back in and wrap
Should we
things
do a
up.
screenshot?
Thank you
Sure.
so much. That was so fascinating. I love the Ross Perez currency. Fingers crossed that's something that'll be real. Some final words, Mariko?
Thank you so much, everyone, for attending. Thank you all to all the panelists and Jerry for moderating. We really appreciate your time and all your thoughts today. Really, really informative and a great discussion. Thanks so much, and we'll
Thank
see
you.
We'll see you
Thank you.
soon.
Thanks.